Hello, welcome back to the show. So in today's video, I'll be talking about sectors to avoid in the stock market today. So in today's video, I'll be covering a few things. We'll be covering a super investor's take on which sectors to avoid, some sectors to invest in, as well as some questions that you guys have left me in the comment section below. So let's take a look at what Chris Hohn said about which sectors to avoid. This is what he said.
What are the type of companies you would never invest in? Type of industries?
Yeah, that's a good question. We have a long list of companies we don't invest in. We're very focused, and we call them the risky and bad industries. And I have invested in some of these in the past, but I've learned. Banks. Sorry for that as a bank.
No, not the bank. You hate the central bank.
Central bank.
Central bank is good.
Yes, central banking can be good, but we don't like banks. We don't like banks.
And why not? Why not?
They're low quality of earnings because they're very leveraged, and much more than people think. You know, because people look at equity to risk-weighted assets, but equity to total assets. Many banks have run it 100 times, and so two, they're opaque.
You can't look into them.
You can't. Yeah, you can't. I remember pre-financial crisis, I had a look at Credit Suisse, and I sat down with the then CEO, Brady Dugan, and said, put his balance sheet in front of him from the annual accounts, and said, you have a multi-trillion dollar balance sheet. Can we walk through the line items? Because I don't understand it. He said, I don't either. He was a very honest guy. I really liked him. He was very honest. And,
okay, so banks you don't do. What else do you do?
And the other reason for banks is very important. You know, that sooner or later, you may find someone without a lot of intelligence comes to run them. And then it could be toxic. Yeah, people going for growth. Anglo-Irish Bank, if you remember that one, Nikolai,
Sure.
Yeah, of course. And they just can destroy the shareholders, yeah, by getting bonuses, you know, best earns, you know, and non-alignment of interests with leverage and opacity, and
so what are the other?
and it's a commodity. Others, many. The auto industry is obviously a commodity. Retail, you know, insurance, the commodities, the commodity manufacturing, tobacco. The truth is, anything in most things in manufacturing. Okay, so most industries are bad industries. Yeah.
So an example of a bad industry to invest in is your banking and your asset manager portion. So the banking sector is often too leveraged, and the way they value their book is a lot higher than expected. So they can value their book at maybe around a 20 times earnings, but in actuality, the book value could be only around a 10 times earnings. So there's some subjectivity when it comes to them valuing the book value as well. Also, your asset to equity ratio may be too high, which signals that the company is highly leveraged. So if you were to look at a company like Brookfield, for example, this is Brookfield's balance sheet over here, and their total assets over here is 400,000 over here. I think it's in millions. And then if you're to compare it to the equity, for example, if you're to just look at the equity and compare it with the assets, the asset to equity is at a 10 times over here. So it is already highly leveraged, meaning to say the actual net worth of the company itself is only 1/10 of the total assets that the company owns. So this is an example of a highly leveraged business, and that is why you shouldn't be investing in the banking sector. Same for your asset manager sector as well, which is what Brookfield does. So next sector to avoid is your retail sector. So retail stocks are typically hard to avoid simply because they have too much competition. So once the hype comes, the fundamentals will go up, and then once the hype dies down, the fundamentals will swing downwards as well. So these companies over here, they are not predictable, and that's why you shouldn't be investing in it. So for example, a company like Nike used to have an oligopoly a few years back, so they were having an oligopoly with Adidas and Puma as well. But the problem in Nike today is that there is a lot of competition coming into this space. So if you have to compare, let's say, Nike's market share in 2023 as compared to 2024, as you can see, Nike's market share actually dropped from 15% to 14%, and I do expect it to continue dropping over the next few years as well, because there'll be more competition coming into this space. So brand name is one of the weakest modes out there. For Nike, it only has brand name. It doesn't have a very differentiated product that everyone needs. Good marketing helps in the short term, a good product will help a company in the long term. And for Nike over here, as well as all these different shoe brands over here, the only thing that they can do is to basically make good marketing campaigns, but they can't make a good product because there's not much differentiating one shoe from Nike as compared to another shoe from Adidas or another shoe from Puma. And so that's why you shouldn't be investing in your shoe segment over here. And this is what Dev Kantasari has said about Nike as well. So he said, we generally shy away from consumer and retail sectors because we find it challenging to predict the staying power of the brands. We have owned Nike in the past, however, as we considered it a brand that could consistently stay relevant through its association with the best athletes around the world. We're not surprised by the recent announcement of the CEO change. Keeping the Nike brand fresh and relevant requires more than just a strong operator. A company like it needs to stay bold and constantly innovate. In the face of softer revenue and growth, companies are prone to become more defensive, cut costs, and become beholden to the earnings expectation of Wall Street. While we did well with the stock in the past, the predictability of Nike has declined over the years, making it tough for us to underwrite. So this is what Dev Kantasari has said. He's saying that the predictability of Nike has declined over the years, which is what I agree with as well. Nike simply faces too much competition in your shoe space over here as well as your apparel portion, and that's why I don't think retail is a good industry for you to invest in if you're looking for an industry to invest in. The next industry to avoid are your airlines and your sugar companies, basically those that are in the commodity sector. So your airlines, they are highly commoditized. Same for your commodities like sugar, oil. The only way to compete is to compete on price. So the airline industry has seen massive growth over the years as people spend more money on travel. But the problem is there's too much competition in the space, and that's why you're not seeing anyone taking up a lot of that growth over the past few years. So if you're to compare your airline stock as compared to the S&P 500 over the past 10 years or so, your airline stock has returned around a 2.16% over the past 10 years, whereas your S&P 500 has returned around 230% over the past 10 or 15 years or so. So clearly it shows that airline stock failed to outperform the S&P 500 simply because there's too much competition. And competition is normally for losers. When there's competition in a space, it hurts the growth of the individual companies in the space, although the industry as a whole can grow together. Next industry to avoid is your automotive sector. So your automotive companies, they are terrible investments because it takes high cost to run the business. It is a highly commoditized product. So apart from companies with strong brands like Race, which is your Ferrari, as well as Tesla, or your different other car brands over here, the only way for them to compete is simply to compete on price again. And what they will typically do is they will lower the prices of their cars so that they can gain more market share, and that will hurt their margins over time. And there's also poor fundamentals for all these different car companies, and they are highly leveraged as well because it takes a high startup cost for them to basically build the factories to build the cars. So for example, this is Ford's net income over the past 20 years or so. And as you can see, there's no predictability in terms of the net income. The net income goes up and then it comes down and then it goes negative and then it goes up again. This is a highly unpredictable business that faces immense competition with terrible fundamentals, and the only way for them to distinguish themselves is through price. So for your automotive industry, they are interest rate sensitive as well. When interest rate rise, people stop buying cars because it is not a necessity, it's a discretionary product. So when interest rate rise, it leads to higher interest loan costs, which leads to less people buying cars. And companies, what they do is they will start introducing buy now, pay later. They will start to seller finance, and when that happens, it leads to higher accounts receivable, which means that there's a higher probability of bad debt over here when your consumers start spending more than they can. So in general, automotive industry stocks, they are an avoid. So what sector should you be investing in? So find companies that sell a product that is a necessity, because good marketing can lead to good short-term gains, but overall in the long term, only strong products can give you high long-term gains over time. So for quality companies over here, there are a few characteristics that was outlined by Chris Hohn earlier as well. He said high switching costs, recurring revenue, the predictability of the recurring revenue doesn't matter, IP, scale, as well as network effects. So I'll be talking about the sectors to invest in right now as well as the best stocks in those sectors. So the first sector is tech. So the best companies with those qualities include Microsoft as well as Amazon. Microsoft has the bundling effect, they have the network effect, they have the barriers to entry because no one can compete with it. So for Microsoft over here, they have high switching costs because they can bundle everything together and sell everything as a package. And for Amazon over here, it's sort of like a network effect. So when people go on Amazon to search for best prices, it leads to more sellers going on Amazon, which leads to more buyers. And this leads to a virtuous cycle over here, which will help Amazon over the long run. The next sector is your financial sector. And for a financial sector, the best two stocks will be Visa and MasterCard. So they have incredible scale and network effect as well. It is similar to the Amazon one earlier. So everyone uses their payment network. If they don't use it, if the merchants don't use it, then what happens is they will lose profits. And this again leads to a virtuous cycle where consumers, they use Visa and MasterCard. So your sellers have to provide Visa and MasterCard, which leads to more buyers using Visa and MasterCard and so on. So Visa and MasterCard, they are highly predictable businesses with characteristics of strong moats over here. So in your credit rating portion, it will be S&P Global as well as Moody's. So they have a recurring revenue business model and the world needs credit. So Chris Hohn said that your predictability of your recurring revenue is not as important as the fact that the company has recurring revenue. So for S&P Global and Moody's over here, they are sort of like toll gate businesses because the entire world functions on credit, and without credit, the world cannot function. So when interest rates go up, although people stop trying to raise debt, they will have to raise it in the future as well. And during that period of time when they are not raising the debt, what happens is S&P Global as well as Moody's, they'll try and raise prices, they will have a higher take rate, and when those people come back to basically raise the debt, they have to pay more to S&P Global and Moody's. So for Chris Hohn over here, what he's saying is that the predictability of the recurring revenue doesn't matter because eventually all this money will still come back to the business over here, which is what S&P Global and Moody's do. Another sector that is highly predictable as well is your railroad sector over here. So you have your Canadian National Railway as well as Canadian Pacific, two stocks that Chris Hohn invests in. So CNI, CP, UNP, they are the largest railways in the US and Canada as well. And they have high barriers to entry simply because the railways, they take a large amount of cost for you to build it up. And it's a natural monopoly simply because there's no one that is willing to spend all those costs to build up all those railways to come and compete in this industry over here. So Canadian National Railway, Canadian Pacific as well as Union Pacific, they are simply just natural monopolies that will stay here over the next 10, 20 years or so, and that's why you're seeing Chris Hohn investing into these stocks as well, although they are quite boring businesses. So Chris Hohn also shared that valuation doesn't matter for high quality business, and what he's saying is quality investing is much better than value investing unless you're paying a 60 times earnings for this stock over here. This is similar to what Dev Kantasarya has said previously. What he said is a compounder can be bought at any price because the compounder's fundamentals will eventually grow and catch up to its stock price over here and valuation. So buying high quality compounding machines is much better than buying speculative hype stocks that will give you excessive returns in the short run, but it will also lead to unlimited downside in the long run as well. Last portion over here, I'll be talking about some questions that you guys have left me in the comment section below. So the first question over here, it says, can you share your views on PDD? Mr. Jack Ma had praised PDD over Baba in the past. It is also more deeply undervalued as compared to Baba. So PDD over here is Pinduoduo. It's a company that is in China. What they do is they operate the Temu app. Temu is simply a Shein alternative. It is the online retail store that sells all your different cheap goods from China itself. So the problem with PDD itself is it is prone to tariffs. So currently now the US is imposing 10% tariffs on China. And if those tariff concerns start to creep up again, then you will see PDD earnings being hit as well because less US consumers will go and buy their goods. As for Temu over here, I think it's an app that is fast growing, but the problem is there is no predictability with this business. The only way for Temu to basically draw consumers in is through its pricing, but you have other competitors coming up as well. You have like Shein, you have Baba, you have your AliExpress and all that as well. And so the competition in this space is very large. And for Temu over here, if it is only able to bring in consumers because of its price, some days that competitive advantage in pricing will basically fade over time. I think Pinduoduo over here, yes, it's undervalued, but I'm not sure what the management does with that cash as well. I believe they have a large cash position, but they're not buying back shares. So I'm not too sure what the management is signaling to its shareholders over here. So for me, I don't think I'll be buying Pinduoduo. I think a better company in China is simply just to buy an Alibaba. Alibaba is a much more predictable business with a much stronger moat, and they have their cloud segment as well, which is growing rapidly as well. So they're not 100% involved in retail. Next question over here, for companies outside of Mag 7, could you provide more coverage on ASML as well as global payment networks? So for ASML over here, I think it's a quality business. It is one of the most highly predictable businesses out there. They have an installed base that is existing, that is growing already. So every year, this will be a 100% retention rate recurring revenue business model that makes up around 20 to 30% of their annual revenues over here. And then you have the 70% which comes from the net system sales, and what they do is they sell the machines. And as long as they still have the EUV monopoly over here, you can expect this company to basically grow with AI. And if you think AI is here to stay, then ASML is an incredible business to own in the next few years or so. As for global payment networks, the problem with the business is simply two things. Number one, they have too much competition in the space. So you have other companies like ADN, Pfizer V, and then you have JP Morgan as well. They're basically merchant acquirers as well. And then for global payment networks over here, the other problem with the business is the high debt. So if you have to look at the debt itself, the debt to EBITDA, I believe, is around a 6 to 7 times. And that is simply too high for the business because it will eat into their margins over time. So when a company has so much debt in a high interest rate environment like what we're seeing today, it leads to a lot of their income being paid to basically service their loans and all that. And so for global payment networks over here, I don't think it is a quality stock for you to invest in. Hopefully you guys have found this one useful and invest safe.